Sure, I'm Ron Cordess, and I have a family foundation, the Cordess Foundation, that my wife and I started about 6 years ago after I'd sold a business in the investment field. So the focus of our foundation is economic empowerment, trying to provide a hand up as opposed to a handout, particularly in the developing world. So we do a lot of work around poverty, education, looking at the roots of poverty and how it is that you end up solving some of those problems. We are. We got involved in impact investing because we became frustrated as a family foundation that 5 or 6% a year we were giving away just wasn't moving the dial in the way that we wanted to. And we kept looking at that other 95% and saying, why can't we do something with that as well? So we've been doing it now for 5 years. We've invested in microfinance, small businesses in the developing world, education loans, clean cook stoves, a variety of different areas, all again focused around economic empowerment, and we've had good financial results. Well, the biggest challenge originally when we started 5 years ago was just finding people who were in the impact investment field. My business was building and managing investment funds, and so our interest was in finding great funds to invest in as opposed to buying interest in individual companies, just because we felt like we could rely then on fund managers to do a lot of the due diligence work, but finding those fund managers was incredibly difficult in the beginning. And so that's what led me, among others, to start this firm Impact Assets, which is all about creating an ecosystem and an infrastructure, and our Impact Assets 50 database is about identifying the leading investment fund managers who are committed to managing for impact, so that hopefully future investors will find it easier to build portfolios and identify managers. Yeah, so I think a lot of studies have been done that indicate that there's a strong amount of both investor interest and financial advisor interest in impact investing. Yet when you really look at the results, very little capital has been catalyzed. And I do think a lot of that has to do with just a lack of awareness and education. On the financial advisor side, and I've worked with advisors for 30 years, advisors are very reluctant to recommend something to their clients that they themselves don't feel very comfortable with. So because this is a new field, and because it doesn't have the type of established track record that many other investment categories have, advisors have been somewhat reluctant to kind of step in, even though their clients are quite interested. So it is about education. It's about making them aware of the opportunities that exist, making them aware of track records that exist in the space that they might not have otherwise been aware of, and getting them comfortable that this is actually an investment that can make sense in their client's portfolio. I think media is critical, actually. In my perfect world, there will be media directed to the affluent investor, the individual investor, the investor with a family foundation like myself, that will inspire them to go to their financial advisor and say, why don't I have any of these investments in my portfolio? I'd like to begin investing this way. What do you have that you can offer me? And to date, that's happening a little bit, mostly with magazine articles. I hear the stories occasionally where somebody will bring a clipping in from a magazine article about microfinance or something else and say to their advisor, I'd like to do some of this. And having worked with advisors for the last 30 years professionally, I can tell you that nothing motivates a financial advisor more than one of their good clients that has a need that they'd like to satisfy. I think that as Jed Emerson and others have so eloquently discussed, I think the world is moving from this bifurcated concept of doing well here and doing good here. The next gens, I spent a lot of time on college campuses. Impact investing and social entrepreneurship are the most popular courses of study. So there's an emerging generation that really feels that you can have both. You can invest in accordance with your values and achieve a financial return. And I think that that's really the trend moving forward, is that people will probably begin by taking a small piece of their portfolio and moving this way, but ultimately I think we're going to see portfolios that fully embrace the concept. It is both simple and sophisticated because the concept itself is quite simple. If you look at microfinance or low-income housing or charter schools, you can easily see how capital can be used to serve a positive outcome and have a return in equity. So they're complicated. So rather than investing in a mutual fund or an exchange traded fund or something someone might buy off of a Schwab account, today the investor's receiving a stack of documents that they need to sign. And it's not necessarily because the underlying investment is any more complex, but the delivery system is still complex. And until the market grows to the point where there are mutual funds, and now we learned today an exchange traded fund with Philippe Cousteau, that's exciting because the more mainstream we can make these types of investments, that's one less decision the investor has to make. They can, in my perfect world, we'll get to a point where if someone wants to invest for impact, they can do it in their 401k account because there'll be an array of options available and they can check the box with respect to what impact they'd like to have. Well, let's see, so I'll give you two stories, and you can pick between them, I guess. So the first one is the day that changed my life with respect to impact investing, and it was in 2008. I had taken a group, my second trip to Africa, I had taken a group of people to a very remote village in Uganda, northeastern Uganda, where we'd funded a fledgling microfinance program. And the first 40 women had received their loans. We were in Uganda, and so we took the 5-hour trek because we wanted to see what types of businesses they'd created with these loans. And we were one of the first groups of people from outside of Uganda to have ever visited this small village. And the women were so proud, they took us business to business, showing us what they'd done. And this one woman stopped us, and it was really clear that she had something really important that she wanted to say, and translated from her tribal language, what she said is, we appreciate when you, people from America, come to Uganda to save our children, but we need to save our own children. Thank you for investing in us so we can do that. And to me, I came back to the U.S. after that trip committed that I wanted to provide that same opportunity for 1 million women because I recognized it was all about a hand up and not a handout. They're not seeking our charity. What they're seeking is opportunity, and they're seeking the dignity that comes with us providing them capital as opposed to some type of a charitable donation, and saying to them, we believe in you enough that we're willing to invest in you. And I think somewhere in that fundamental dynamic is why 98% of these microloans get paid back. It's not about collateral, it's not about security, it's more about just the basics of human dignity. And people appreciate the fact that they've been given this great opportunity and they're going to do everything they can to repay it back. Well, my other one was, I started as an impact investor in 2007. And we have a small family foundation, we have an outside board, so we'd gotten our board to commit to putting 20% of our portfolio in private debt and equity invested for impact, in economic empowerment. And the irony is that it took us a while to become fully invested because the market was like the wild, wild west. It took a while to find the deals. So we became fully invested in early 2008. And as everybody remembers, September 2008, the wheels come off the financial markets. Well, I told my board when we first made the commitment, we're going to be a little early in this space. So we may lose some money, but we're going to lose it as a field builder. We're going to lose it learning something and hopefully proving some cases that can help others down the road. So at the end of 2008, I was fully prepared that I was going to be eating some crow when getting together with my board because of where the markets had gone. And come to find that when we looked at the portfolio in early 2009, that 20% had actually outperformed the other 80% in our portfolio. And the primary reason is we were invested in microfinance and small business at the bottom of the pyramid in the developing world, and to a large extent, those businesses, those financial organizations had largely escaped the global financial crisis. So I stepped back and looked at this and said, now I can actually empirically verify in my portfolio. These assets were uncorrelated to the global markets, and not only did they underperform, but in a period where everything else blew up, I had solid performance. And that's really what inspired me to start Impact Assets and say, this can work financially, and the reason why more people aren't doing it is just because we don't have an awareness campaign and an ecosystem and an infrastructure to help them do it. So I guess one last thought is that it's easy for me to understand as an investor and as a financial advisor why this would make sense. As a financial advisor, it's a great way to have a connection with your clients, a connection with the next generation. I actually argue with financial advisors that it's a great business building strategy. But I also look at it kind of in the thread of our collective humanity, that what really gets me up in the morning is the fact that, in the U.S. we're the most charitable nation on the planet. We give away $300 billion a year in philanthropy. We've got 1% today of our government budget, over $30 billion a year, that goes to foreign aid and development assistance. And yet when you couple all that together, while it's an enormous amount of money, it pales in comparison to the global problems that we're trying to solve. So the way I look at it is, what if in addition to that, we were able to catalyze even 1% today of the $40 trillion capital market in the U.S., that's $400 billion. It would more than double what we're putting in today. And I think that's there. I think over the next 3 to 5 years, we're going to find that I call it the little pocket and the big pocket. Today we're trying to solve all the problems of the world, very well intentioned, out of the little pocket that's growing smaller. And we've got this big pocket of capital from investors that I believe have the heart to do this and will do it once they understand the opportunity. And the challenge for us is to open that big pocket and get that 1%, 2%, 3%, is to educate these investors and their advisors and give them an opportunity to understand really what the opportunities are and the fact they exist.